This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now we're going to look at modified opinions. But just before that, let's get clear the difference between a modified report and a modified opinion. A modified report simply means that something somewhere in the audit report is modified. And the report is like a page of A4, lots and lots of paragraphs within it. If you talk about a modified opinion, we're just talking about modifying that one paragraph which has headed up the opinion paragraph, or of course its name will change once it's modified to qualified opinion or adverse opinion or disclaimer of opinion, to warn people that it's not a straightforward, clear audit opinion. Now, we've dealt really with the one side of this diagram already, but we'll just emphasize it again. When we go down this side here, matters that do not affect the auditor's opinion, these are essentially extra paragraphs that we put in below the audit opinion. So the additional paragraphs we would have could be material uncertainty related to going concern, and provided the directors have a note in the accounts explaining the problems with going concern, really what this paragraph is doing is referencing that, waving this red flag, saying people, as seen in note 18, whatever, there's going concern doubt. But it's not any criticism of the financial statements. Or it could be emphasis of matter, relatively rare now, or another matter, for example, drawing people's attention to the fact that the director's report and the information in it is inconsistent with the financial statement which we have audited. But again, that is not a modified opinion, that is not a criticism of the financial statements, it's more a criticism of the director's report. But as that's not part of the financial statements, we can't do any sort of qualification on it. So, provided the directors make the right disclosures, putting in these extra paragraphs are not ranking as any form of change of auditor's opinion. We're saying the financial statements are as good as they can be. However, anything going down this paragraph, this side of the diagram, is in the nature of a criticism of the financial statements. There's something wrong with them, or we've not been able to get all the evidence we need. And this does affect the auditor's opinion. This is called a modified opinion. And there are kind of three varieties, I suppose, of modified opinion. You can have what's called an except for, and this is often called a qualification. In fact, the word qualification is often used as a kind of generic term meaning modified opinion, but it shouldn't be. The term qualified audit opinion should be kept for except for. So this is saying most of the financial statements are okay, they're true and fair, except for the valuation of inventory. That's what's meant by qualification. It's okay except for. But for this, it's all right. And we can be issuing this qualified opinion either because we think this relatively small but material part of the financial statements is actually wrong, or the directors haven't made the right disclosure, or we haven't been able to get sufficient appropriate audit evidence to satisfy ourselves that this little part, discrete part of the financial statements has been fairly stated. The other two types of modified opinion are more serious. The first one is a disclaimer. A disclaimer saying we can form no opinion on the financial statements. Really saying not on any of them. And it's really saying that the financial statements are pretty useless. Similarly, the adverse opinion is saying the financial statements do not show a true and fair view. And it's really not worth relying on those either. So both disclaimers and adverse are coming pretty close, if not actually saying that the financial statements are a waste of paper. because you can either put a reliance on them, or we definitely think they are fundamentally flawed and do not show a true and fair view. Now, the moving, if you like, from a qualified to a disclaimer or an adverse is something which is not absolutely cut and dried. So here's the normal qualification matrix here. So the top one here is where we're criticizing the financial statements because we think there's something wrong with them. So they contain a material misstatement, and if it's material but not pervasive, it's except for. If it wasn't material, we wouldn't be doing any sort of modified opinion. So we'd be saying something like, except for the allowance for bad debts, the financial statements show a true and fair view. We'd be gone to saying, if that had been the way we wanted it, the profit would be down to a certain amount and so on. We if you like, fill up the gaps, if you like. We do as much as we can to correct people's impression of the financial statements as we do the qualification. At some point that will move to adverse, and the key word is, a difficult word is pervasive. Pervasive can mean extremely material. It can mean a problem which is maybe going to be affecting lots of areas of the financial statements. It certainly means we can't easily isolate the effect of this misstatement and therefore say that the remainder of the financial statements are okay. Similarly, we have the two-step process down here. If we haven't been able to get sufficient appropriate audit evidence, we'll go from here, except for the fact that we were not told about the stock take and couldn't attend it, and therefore have no information about the closing stock, and we couldn't find the information any other way. If the inventory was material, but pretty isolatable in terms of its effect on the cash flow, the profits, etc., then it could be an except for type of disclaimer, not disclaimer, but unable to obtain sufficient appropriate audit evidence. If there's a huge great hole in our evidence, so there were very, very material figures for which we had insufficient audit evidence, we would say that we really can't isolate this gap in our knowledge. It is pervasive, it's essentially affecting everything. Now, auditors by and large are fairly reluctant to go down these routes. If you go down these routes, you are telling the shareholders that really very little can be learned by looking at the financial statements. The financial statements are essentially useless. It is, if they can do it, it is much more useful to be able to say except for. So this is the wrong bit and the rest is okay. And you can make your economic judgments based on most of what is there. And that is much more useful type of change of opinion than going down adverse or disclaimer. It has to be pretty serious. Got a few examples here. Here is one for insufficient evidence, and it's a qualified opinion, so it's not pervasive. We didn't observe the counting of inventories at the year end, and able to determine the inventory amounts by any other methods. In our opinion, except for the effects of such adjustment, if any, and of course, if you haven't got the information here, we are unlikely to know what this unknown effect is. It's a hole in our knowledge, really. If we've been able to satisfy ourselves as to physical inventory, otherwise the financial statements do show a true and fair view. So isolatable, limited, but material gap in our evidence. Disclaimer of opinion here, you see it's exactly the same cause, not being able to observe all physical inventories here. But here the inventory is such a material item in the financial statements, so that maybe if it was like 10% wrong, we would go from a nice profit to a rather kind of nasty loss, something of that type. and there's kind of no way through it. And if you don't know whether somebody's making a nice loss or a nasty profit, then pretty much you would be forced into saying, I'm going to display my opinion on these financial statements. Don't put your faith in them. Qualified opinion for a misstatement. Here it is saying that no depreciation has been provided in accordance with international accounting standards. But usually with a misstatement of some sort, you can do the corrections. We said, if depreciation had been applied at 20% or whatever we think it should be applied to, then we know the effects on the profits. We know the effects on the non-current assets and so on. And it is useful, therefore, to quantify that for the members, the shareholders, and they can make their own little mental adjustment about what the profits would have been had they done it the way the auditors wanted. And then an adverse opinion here is dealing with irrecoverable debts. There's this big customer gone into liquidation, owing £2 million, dollars, whatever it's going to be here. And in terms of the size of the company here, given that we don't expect anything to be recovered from this liquidation, again, it is kind of fatally undermining anything we could say about the company. It might even be leading to going concern problems or those sorts of issues. And therefore we're saying the financial statements do not show a true and fair view, because, this should have been put through the financial statements. But at the minute they're, far too rosy, if you like, in all sorts of different ways, for us to be able to do anything other than to express an adverse opinion. There is in our site a worked exam question dealing with audit reports. It's a question Willis. It's from December 2010. It's been amended very slightly. And there's a video working through the approach to that, and it's well worth looking at.